Welcome to today's Explainer, where we are going to explore how to finally break free from the daily grind. We hear the term passive income thrown around constantly, right? But what does it actually mean? Is it just some internet myth, or is it a mathematical certainty if you just apply the right leverage? Well, based on today's source materials, we are going to map out the exact blueprints that real people are using right now to generate substantial wealth while completely off the clock.
Okay, so here's our roadmap for today. We're going to cover 1. The passive income illusion, 2. The digital creator path, 3. Scaling your expertise, 4. The dividend income machine, 5. The crypto yield frontier, and finally, 6. Choosing your wealth strategy.
Starting right off with Section 1, the passive income illusion, moving past the myths. Let's get a quick reality check on what it actually takes to build wealth. Because, let's be honest, passive rarely means zero effort from day one.
Now, we've got to start by challenging a huge cultural assumption. See, we are culturally conditioned to believe that the only real way to earn a living is to clock in and then clock out. But our sources reveal that true passive income requires fundamentally restructuring your entire relationship with value creation.
The absolute essential mindset shift here is moving from trading your precious time for dollars to leveraging your money or your upfront effort for a continuous return. Business strategist Chris Do explains in our sources that traditional labor is basically just exchanging your time for an hourly rate, but true wealth, that's built when you start trading your money or your digital assets for more money. You're essentially building an engine that runs whether you're sleeping, traveling, or just hanging out with your family.
Moving right along to Section 2, the digital creator path. High effort, low upfront capital. Now this is the perfect entry point if you've got plenty of time and hustle, but maybe very little startup cash.
Take Wendy Nolan as the perfect example. She is a grandmother who totally defied the tech odds to generate significant income entirely from scratch. She started at 55 years old, no fancy tech background whatsoever, just creating simple digital products. And she was actually able to walk away from her full-time job and generate over $45,000 in just 4 weeks. It's a phenomenal testament that it is literally never too late to start leveraging the knowledge you already have. Now, her blueprint is actually really straightforward, but highly proven. You research high-volume search terms like, say, dog training, you build a simple digital guide, add in some affiliate links, use YouTube as an evergreen search engine to drive your traffic, and eventually, you build a paid community. You start by finding what people already want, create the asset, layer in products you recommend, and then you just let the internet do the heavy lifting of selling it for years to come.
You know, it turns out people absolutely crave genuine human connection, and they'll happily pay for spaces where they feel truly supported. Once you have an audience, the ultimate recurring revenue stream is a digital community. In this crazy age of AI and automation, just providing a space for human connection, shared wins, and accountability is incredibly valuable.
To put the sheer power of community into perspective, just look at this staggering number. This represents the monthly recurring income from a niche pickleball community hosted on the school platform. Let that sink in for a second. A simple, specialized community generating over $46,000 every single month. Wendy herself built a community that brings in $11,000 of monthly recurring revenue after just 4 months. That is the compounding power of the digital creator path in action.
All right, let's jump to Section 3, scaling your expertise, buying back your time. What if you already have a service-based business, but you feel completely trapped doing all the manual labor yourself?
Imagine you've got a project with an $850 day rate. By delegating that project to a talented editor for, say, $500, you instantly buy back your time while keeping a sweet $350 profit spread. This concept, which is outlined by Chris Do, is exactly how you insulate your business. You make excess money, and the very first thing you buy is your time back. You find the talent gap, those talented individuals who just don't want to manage clients or take on business risks themselves, and you connect them with the buyers.
As the sources from the future point out, your main goal here is to evolve from a solopreneur exchanging hours for dollars into an agency owner who simply manages the process. And guys, this is a massive identity shift. You're no longer selling the fact that you do the work, you are selling the fact that your business achieves the result. That freed up time then allows you to create highly scalable assets like courses or automated lead generation systems, creating true leverage.
Next up, Section 4, the dividend income machine. High capital, low effort. We now arrive at the heavy hitter for those with existing capital. This is where your money literally does all the heavy lifting for you.
Imagine seeing this massive number hit your bank account every single month. Well, that's exactly what retired IT architect Perry achieves passively from his $1.4 million portfolio. Perry tracked his yields religiously, and he realized that traditional balanced portfolios growing at just 5% really weren't enough to comfortably live off the income without eventually melting down the principal. So he transitioned over to high-yield dividend strategies.
Financial educator Njitika breaks this down brilliantly in our sources. To hit $75,000 a year with traditional dividend aristocrats, which are basically just massive, stable companies that slowly raise their payouts, you'd need about $1.5 million invested. But if you utilize REITs, real estate investment trusts that are legally obligated to share 90% of their profits, or covered call ETFs yielding around 12%, you only need about $625,000 invested to hit that exact same income goal.
So how are these double-digit yields actually possible? Well, we need to define covered call ETFs. They basically act like insurance policies for other investors while paying you the premiums. You get to collect the dividends from the underlying stocks, plus the premiums from selling the options. It's highly capital efficient. Funds like QYLD and JEPI consistently yield between 9 and 15%, and the best part is they often pay out monthly.
But hey, risk management is absolutely key here, and our sources show how utilizing a strict target holding weight ensures your portfolio stays diversified and safe. Perry tracks over 100 ETFs across different accounts, making sure no single ETF makes up more than 5% of his entire portfolio. If one sector takes a dive, his income stream is completely insulated. He keeps 15% in pure growth to build capital and a massive 85% in covered calls for that sweet monthly cash flow.
Now let's dive into Section 5, the crypto yield frontier, emerging decentralized finance. While this is definitely more volatile, the technology evolving here is absolutely fascinating.
At the very heart of this space are automated market makers, or AMMs. Think of them as robotic financial algorithms that are replacing traditional banks. As detailed in our crypto info source, instead of a bank holding the money and taking all the fees for themselves, the blockchain actually allows everyday users to provide the liquidity and collect the fees themselves.
By tossing your crypto, like XRP, into these liquidity pools, your assets are facilitating trades for other people, which earns you a continuous, passive share of those transaction fees. It's essentially like acting as your own decentralized currency exchange. Every single time a trader swaps an asset through your pool, a small fee, usually around 0.3%, gets distributed directly to you and the other liquidity providers.
When you compare this to traditional 5% dividend yields, crypto staking and DeFi farming can offer highly competitive, though admittedly volatile, annual percentage returns for the bold investor. The sources note that platforms are emerging right now that allow you to wrap or stake your assets for estimated yields of 5 to 10%, or sometimes even higher with yield farming. However, and the sources explicitly warn about this, you've got to watch out for price volatility and something called impermanent loss. That's when your deposited tokens lose value compared to just holding them. So it's high risk but a totally viable frontier for the technical investor.
Finally, we arrive at Section 6, choosing your wealth strategy. Time versus capital. It's time to synthesize all this information and figure out how you can actually apply this to your own life. We've basically demystified passive income today by mapping out 4 distinct strategies across the spectrum, proving once and for all that there isn't just a single get-rich-quick scheme. If you're starting from zero, the digital creator path is waiting for you. If you're a burnt-out freelancer, it's time to scale into an agency model to buy back your time. If you've got capital sitting around, you can optimize it into a dividend machine. And if you're super tech-savvy, the decentralized finance space offers entirely new mechanisms for yield.
So, I'm going to leave you with this final thought to ponder. Evaluate your own assets today and decide which of these paths you are finally ready to embark on. Are you going to trade your time to build an automated digital asset, or are you going to deploy your capital to buy back your freedom? The entire spectrum is right in front of you. Thank you so much for joining me